you take the foreign earned income exclusion or deduction and you still have leftover foreign income that cannot be excluded, you should think about taking a foreign tax credit on the amount that cannot be excluded. So what does the foreign earned income exclusion mean when it comes to U.S. taxes? What about the foreign housing exclusion or deduction? Well, it's possible that you may be able to exclude some of your foreign earned income from being taxed in the U.S. if it's income from wages, salaries, professional fees, or personal services that you provided. You also may be able to claim an exclusion or deduction from gross income for your foreign housing amount if your tax home is in a foreign country. If you live or work abroad, the foreign earned income exclusion and the foreign housing exclusion or deduction are tax breaks that could help legally reduce your U.S. federal tax bill. U.S. citizens and U.S. resident aliens have to pay U.S. federal income taxes on all of their income, no matter where it is earned. As an American expat, this could mean that you are being double taxed because you're being taxed both in the U.S. and in the country where the income is earned. Before we get into how you might be able to save on your U.S. taxes, I do want to let you know that what we are about to go over is not legal or tax advice. Every situation is different, so please discuss your specific situation with your financial and tax advisors before you do anything. First of all, you cannot take the foreign earned income exclusion for a distribution of earnings and profits from a corporation for personal services that you provided. Here are other types of income that would not be classified as foreign earned income. 1. Pay received as a military or civilian employee of the U.S. government or any of its agencies. 2. Pay for services conducted in international waters or airspace. 3. Payments received after the end of the tax year for services that you performed during the tax year. For example, if you performed work in December but didn't get paid for it until January, you cannot include this amount in foreign income in the year when the work was performed. 4. Pay that you can exclude from income, such as the value of meals and housing, provided to you for the convenience of your employer on their premises. In the case of housing, it would have to be as a condition of employment. 5. Pension or annuity payments, including Social Security benefits. 6. Investments. And 7. Gambling. Once you choose to exclude your foreign earned income, this means that you have elected to exclude your foreign earned income for all later tax years as well, until you revoke the election. You may be able to exclude all or part of your foreign earned income. The amount that you can exclude is adjusted annually for inflation. For 2023, you can exclude up to $120,000. You do have to meet certain qualifications to claim the exclusion though. So let's take a look at those. You must have foreign earned income and your tax home must be in a foreign country, and you must be either A, U.S. citizen who legitimately lives uninterrupted in one or more foreign countries for the entire tax year. B, a U.S. resident alien who is a citizen or a national of a country with which the United States currently has an income tax treaty and you live uninterrupted in one or more foreign countries for the entire tax year. Or C, a U.S. citizen or U.S. resident alien who physically lives in one or more foreign countries for at least 330 full days during 12 consecutive months. In addition to excluding some or all of your foreign earned income, you may be able to claim an exclusion or deduction from gross income for your foreign housing amount. If your employer paid for your foreign housing or paid you directly for your foreign housing, and if the amount paid is taxable foreign earned income, you can claim a foreign housing exclusion. If you claim a foreign housing exclusion, you have to calculate it before you calculate your foreign earned income exclusion. You must claim the full amount of the housing exclusion that is calculated. If you paid for your foreign housing with self-employment income, you would use the foreign housing deduction. If you're self-employed and take a foreign housing deduction, your deduction cannot be more than your foreign earned income minus your foreign earned income exclusion plus any housing exclusion. You will never have both a foreign housing deduction and a foreign housing exclusion unless you were both self-employed and an employee during the tax year. Also, although the foreign housing exclusion or deduction will reduce your regular income tax, these amounts will not reduce your self-employment tax. Whether you can take a foreign housing exclusion or deduction, you will not be able to exclude or deduct all of your housing. Your foreign housing amount is the total of your foreign housing expenses for the year minus a base housing amount. Yes, you guessed it. If your expenses do not exceed the base housing amount, you won't have a foreign housing exclusion or deduction at all. The maximum you can claim in housing expenses is 30% of the foreign earned income exclusion limit. So for 2023, that would be 30% of $120,000, which is $36,000. To add even more fun to the mix, there may be a limitation based on where you lived. The IRS usually publishes these geographic limitation amounts every year, and oftentimes the geographic limits are higher than the 30% limit. So if the IRS provides a geographic-based limit, you would use the geographic limit instead of the 30% limit. Now, foreign housing expenses cannot exceed your foreign earned income for the year, and you can only take housing expenses during the time that you qualify for the foreign earned income exclusion. Housing expenses are things such as rent and utilities. However, it does not include lavish expenses or meals, furniture that you purchased, although you can include rented furniture, the cost of buying a home, or home improvements or expenses that increase the value of your home or extend the life of your home. If you take the foreign earned income exclusion or deduction and you still have leftover foreign income that cannot be excluded, you should think about taking a foreign tax credit on the amount that cannot be excluded. The foreign tax credit can be used to offset income tax paid abroad and can be used on earned and unearned income such as dividends and interest. There are no restrictions on the amount of foreign income that can be used to claim a foreign tax credit, and you do not have to prove your residence in an overseas location. Now, if you decide to exclude your foreign earned income or foreign housing costs, you cannot take a foreign tax credit on the income that has been excluded or could have been excluded. When I was an IRS auditor, most of my adjustments for foreign income would come from taxpayers who elected to take the foreign earned income exclusion, and then the taxpayer would take a foreign tax credit on income that could have been excluded under the foreign earned income exclusion. Basically, what would happen is taxpayers would elect to take the foreign earned income exclusion, but would not take the full exclusion amount. Then they would take a foreign tax credit on the amount that they should have included under the foreign income exclusion. Well, again, that's not allowed. So if you take a foreign income exclusion, a foreign housing exclusion or deduction, please do not take a foreign tax credit on any amount, even if you choose not to include the amount that should have been included with your foreign income exclusion or foreign housing exclusion or deduction. All the best to you.